All right. So, what questions? I'm not going to start right now, but what questions are burning questions about rates that any of you have that I can answer during the course of this instruction?
I just started 2 months ago. So I went in Google and I saw all the interest rates since the 70s.
Yes.
And I saw a roller coaster.
Yes.
So right now, do you think from your experience, from the charts, and being in this country for a long time,
Nice.
how is like what makes the things go up or down, or what will make it go lower in the future or higher in the future?
I'll answer that.
Yes.
Yeah, that's what this is all about. It'll talk to you about like what drives rates. Yeah. I'm going to explain those too, so you'll understand how to read those.
Okay, yeah, because I'm like, oh, that's green. We're doing good.
Yeah, green is good, red is bad.
Yeah, but anything.
Huh?
Anything.
Kind of. I'll explain. Yeah, I'll show you guys how to read the charts and all that good stuff, so you can understand. But more importantly, like I'll go ahead and start actually. So I'm going to start now. So yeah, what I'm going to talk about is like what drives rates, so that you guys can see the different things. Can you close that door? Thanks. So that you guys can see like what is going to move rates that day. So what I look at are charts on how mortgages are trading, right, on the secondary market. And I'm going to talk about that today. You won't know, like, I'm not going to give you so much information where you're going to know, like, go work at Goldman Sachs on their bond trading desk and do that, okay? Because it's very, very complicated and it's crazy. And I've been doing mortgages for 20 years and like I can't even do that. But I do have a good understanding of what makes these markets move. So there are a few things that you guys can look at that will tell you what's going to happen with rates. One, it's my daily updates I give. Obviously, that'll let you know what's going on. But if you don't have access to that stuff, you can simply look at some very specific key economic indicators to determine whether or not rates are going to go up. So hopefully everybody can see my screen. And why is this now not working for me? All right, your presenter today, very close resemblance to the real thing, I promise you. So yes, I am Jesse. You all know me, and there's nobody here from another agency, so I can't like really talk myself. So I've been doing loans for a really long time. I'm not a dinosaur. I'm still relatively young, but we do all sorts of different stuff in the office. We do conventional FHA, bank statement loans, debt service coverage ratio, construction, FHA construction, private money we do now. Hometown Heroes, we have that also, so we can offer that to your clients. We have other down payment assistance loans. So I'm kind of the Superman. I'm not the only one saying it, and I have a great stash. Other people say good things about me too, so I'm happy about that. Karina is my biggest fan. She's on the Zoom, so happy about that. So this is a question that I get all the time, and this is a question that doesn't make me upset. So when people say that the Fed raised or lowered interest rates, has anybody heard that before? The Fed raised rates, or I'm going to wait because the Fed is going to bring mortgage rates down. Have you heard that?
Yeah.
Right? Okay,
Yes.
so everybody has heard that, right? Hey, I'm going to wait to do something because I heard that the Feds are going to lower mortgage rates in the future. So the number one thing to tell people, if they tell you that, the Federal Reserve does not raise and lower mortgage rates. Okay, they raise the federal funds rate. And the federal funds rate, it says what it is right here on the screen. It's the interest rate at which depository institutions trade federal funds. Okay, these are deposits that are held at the Federal Reserve, and they trade them with each other overnight. Okay, it's an overnight borrowing rate. So overnight is not 30 years, right? When you do a 30-year fixed rate mortgage, that money is held in your portfolio for 30 years unless it's paid off earlier, right? So the federal funds rate is, let's say Osama's Wells Fargo, I'm Chase, we have excess money held at the Fed, right? And I need to borrow money from Osama because he's got too much there, and I need overnight liquidity. I'm borrowing money from him at the federal funds rate. And then the next day, I give him his money back with interest on however much I borrowed, okay? And it says at the bottom, when an institution has surplus balances in its reserve account, it lends to other banks in need of larger balances. So it's liquidity. So you are fulfilling liquidity with each other. So there are rules that have been passed, and it's congressional, it's acts of Congress, that says that banks have to have a specific amount of money in reserve, right? Well, why do we have money in reserve? If there's a banking panic, a run on the bank, or if an investment goes bad, they still have to have money in reserves, right? In case something goes bad. They can't just lend all the money out, right? So those reserves are held at the Federal Reserve, and then it's borrowed and lent to each other at an overnight rate. So I was just telling Yulia what the federal funds rate is, how people say, hey, I'm going to wait 6 months because the Federal Reserve is going to lower interest rates. Have you ever heard that before? Right. So the Federal Reserve doesn't raise and lower mortgage rates. That's the overnight borrowing rate between banks, right? So that's how you can answer that question. And I'm just going to move this to the side so I can see my screen. So that's what the federal funds rate is. So they don't have anything to do directly with raising mortgage interest rates. However, some of the reasons why they raise and lower the federal funds rate will have an impact on mortgage rates. And I'm going to explain what those things are. So they don't have a direct access to mortgage rates, but things that they move in the market definitely will affect mortgage rates. So the Fed can control them, just not directly. They don't raise and lower mortgage rates, okay? But the reason why they do things, that is why rates go up and down. Okay, so this is, everybody's seen this one before. So this is our Fed Chairman Powell walking with 50 basis points. That's what everybody thought he was going to raise the federal funds rate by, and he's checking out 25 basis points. So when we talk about basis points, and I'll talk about that in this presentation, 100 basis points is 1%. Okay, 50 basis points is 0.5%. So Treasury bonds, isn't this exciting? Treasury bonds and mortgage-backed securities. So Treasury bonds, this is what the mortgage market most closely follows, okay? And in my morning updates that I send the Treasury bond yield, okay? And this talks about different Treasury bonds. So Treasury bonds are considered to be risk-free investments. So does everybody know what a bond is and how a bond works? Okay, most people don't know what the bond is. So a bond is a debt instrument. So if I am somebody looking to gain money, raise money quickly, I sell a bond, and corporations sell bonds, the US Treasury sells bonds. So they sell bonds and they get $50 million for that bond, and they offer a rate of return to the investor, and they have different maturity dates. So they're from a few days up to as many as 30 years. So the United States sells 30-year bonds, which means that somebody buys, say, $50 million in 30-year notes, 30 years from now, they get that money back. That's a long time, right? And then the government pays interest payments on that. What's up, LJ? Every 6 months to the investor if the maturity term is 6 months or greater. If not, they just pay them back at the end of the term with interest, okay? So Treasury bonds is what mortgage bonds follow, and I'll explain why in a second. So they're auctioned off, and investors purchase these bonds at auction. So yesterday I was saying, and this morning I was talking about how the 30-year bond auction went really, really bad. Not many people wanted to buy 30-year paper, and so the Treasury had to offer higher yields, which is a higher rate of return to investors, in order for them to buy that paper, and that destroyed the mortgage market yesterday badly. So we'll see if we can recoup and rebound from that, and I'll show you like the correlation between the spreads between Treasury yields and mortgage-backed securities. So a yield is a rate of return, basically. It's the amount of money that you receive for that investment. So what happens is the Treasury announces that they're going to be auctioning off an amount of bonds, and they say, hey, we're going to auction off 10-year Treasuries. We're going to auction 50 million in 10-year Treasuries on next Friday. And so you have like pension plans, 401ks, they're direct and indirect bidders. You have foreign countries, foreign corporations that buy US debt, right? And so what they do is they say, okay, I'm going to buy $5 million of that Treasury bond, and I want a rate of return of 4%. And then somebody else says, hey, I'll buy 10 million of your bonds, but I only want a 3% return. And so it's literally an auction process. And they fill out these bids until all the bonds are sold, and they have a stop out on the yield. And so they won't go above a certain yield, and then they'll have the low yield, and they'll fill the orders based on this auction style. So if you don't have anybody bidding, if I'm the only guy bidding, then the Treasury has to give me a higher yield because I don't have any competition. If all of us are bidding in this room on Treasuries, then the yield is going to come down. So what drives those yields? Well, one, it's how do people feel in the United States paying back their debt? That's one thing, right? So if someone's going to lend to the US Treasury, it's risk-free, right? The Treasury is going to pay back its debts. If they lend to me, I may not be paying back my debts. And so I'm going to have to offer a higher yield in order for you to invest in me. Does that make sense? Okay, same things with treasuries. So you could see pension plans, foreign entities, they purchase these treasuries. So why do we care right now about inflation? Because everybody's talking about inflation, and inflation is what's driving rates. So time value of money says that the longer some money sits somewhere, the less value it's going to have 10 years from now than it has today, right? So your dollar has more purchasing power today than it's going to have 10 years from now, right? So if you're putting $10 million in a bond and you're not going to get paid back for 10 years, you're not getting that money back, you need a serious yield, a rate of return on that investment to make it worth putting $10 million in an investment today. So there's laws that say, hey, you know what? If you're a pension plan or a life insurance company, you can't invest in risky assets, the stock market. You have to put your money in bonds, or you have to put a certain amount of money in bonds. So the Treasury is the safest. It's a AAA rated bond. Nothing is safer out there than the US Treasury bonds, okay? And our credit can change depending on whether or not like we're hitting a debt ceiling and maybe people think we won't be paying our debts back. The borrowing cost for the United States can grow. So bond yields, this is very important on how, when you listen to the news and you hear them talking about inflation, when you hear them talking about inflation rising, that's a key indicator to say, okay, bond yields are going to be increasing because inflation is going higher. So that's something that you can tune your ear to. So bond yields rise with inflation to compensate for the loss of purchasing power, which is what I just said, of future cash flows. And bonds with the longest cash flows will see their yields rise and fall the most. So that's why a 30-year and a 10-year bond are going to be the highest, and or I should say the greatest spread in yields changing, right? So an overnight or a 3-week bond, it's not going to have that change because the time value of money says, hey, I'm lending money today, I'm going to get it back in 3 weeks. So it's almost the same value, right? 10 years from now, it's not going to be the same value. So what have Treasury yields done? So this shows Treasury yields going back to 1980 approximately, and it goes and shows you where we were at as of February 6th of this year. And you can see February 6th, the 10-year Treasury yield was 3.6%. Look at this Treasury yield dating back to 1980. It was over 12.5%. So when you hear people say, oh, I remember mortgage rates in the 70s and 80s being in the high teens and maybe even 20%, that's because the 10-year Treasury yield was 12.5%, and those mortgage bond sellers had to offer a greater rate of return to investors to buy those mortgages. So we need to be really, really keen on what's happening with Treasury yields because that's going to drive mortgage rates higher, right? So look at 2020. Our Treasury yields, have they been lower ever? No. So when somebody says, hey, rates are going to come back to 2.5%, what are the odds? You're not in the mortgage industry. Do you think by looking at this chart, knowing that mortgage bonds follow Treasuries, do you think that mortgage rates are going to come back to 2.5%? No. Right? Now they might. So why in 2020 we had COVID, right? And the Treasury was selling bonds. The Federal Reserve was buying tens of millions of dollars since 2008. They've been buying tens of millions of dollars in treasuries per month. They bought a third of all treasury issuances. A third, 33% of all treasuries issued were purchased by the Federal Reserve dating back to 2008. That's crazy, right? So when the Federal Reserve, anybody know what the Federal Reserve, I'll ask you this question. Is the Federal Reserve part of the United States government, or are they not part of the United States government? 2 people said no. Does anybody in the room think that the Federal Reserve is part of the US government?
I would say yes.
Okay, the Federal Reserve, if I hope that this is the one thing that everybody learns from this. The Federal Reserve is a group of private bankers. They are not part of the United States government. The Federal Reserve issues and controls the monetary policy of the United States. The Federal Reserve is the United States central bank. It is a banking cabal, and cabal has a negative connotation. What that means is it's a group of private bankers, and they establish our monetary policy. The Federal Reserve has the ability to create money, which they do, and set the monetary policy of the country. So the Federal Reserve creates money out of thin air. They don't pay for it. It is created in a system, zeros and ones, and then it buys treasuries from the United States Treasury, and it gets a return of interest from the United States Treasury. Did the Fed do anything to create that money? No. So they don't care what their rate of return is because it's not costing them anything to generate $50 million. So you have the Federal Reserve that's buying the debt of the US government, creating money out of thin air and getting a rate of return. So the reason why yields got driven low for so long is because the Federal Reserve was printing money and buying US debt for free and getting a rate of return. Pretty good deal, right? And it is their private bank, not part of the US government. It's the central bank of the US government. It is not part of the US government. Okay. So that's the real deal. So yields dipped. So the Federal Reserve at the end of 2020, or let's see, no, 2022. So the end of 2021 quit buying bonds altogether. They quit buying mortgage-backed securities and treasuries. So what you see, look in 2022, the beginning of 2022, what happens to bond yields? They jump a lot in a very short period of time. That's because the Fed backed out of the bond market entirely, and we had inflation, right? What we just said on the previous slide, inflation will drive bond yields higher because of the time value of money, okay? So those 2 things contributed to bond yields increasing. So now we know what yields are on these bonds, and this is crazy stuff. Like if we come back into this 1990 period, so I started doing loans in 2003, right? So we had rates in this time, they bounced up. We were doing loans that were like about 7%. Okay, so we've seen these rates come and it's not been that big of a deal, but when you go from so low for so long to higher in a short period of time, that's what shocks the market. So this is, I don't know if anybody's seen this movie. Anybody seen The Big Short?
No, I've been meaning to watch it.
Okay, so The Big Short is a very cool movie based on a really cool book. I geek out on this stuff. Michael Lewis, he wrote Moneyball. Does anybody remember that movie? Brad Pitt was in it. It was about the Oakland A's. Blindside. And then, right, he used to work in Wall Street. So he's written a number of books about Wall Street, financial trading, all that stuff. Really cool. So this is a great book. This is going to explain what mortgage-backed securities are better than I can do. And I'll kick it off. It's only about a minute.
In the late 70s, banking wasn't a job you went into to make large sums of money. It was a fucking snooze. Filled with losers, like selling insurance or accounting. And if banking was boring, then the bond department at the bank was straight up coming. We all know about bonds. You give them to your snot-nosed kid when he turns 15. Maybe when he's 30, he makes $100. Boring. That is until Louis Ranieri came on the scene at Solomon Brothers. You might not know who he is, but he changed your life more than Michael Jordan, the iPod, and YouTube put together.
Let's get some money in here. Let's get some money while you got it.
You see, Louis didn't know it yet, but he'd already changed banking forever with one simple idea.
The mortgage-backed security, or private label MBS. You got your average person's mortgage, fixed rate, 30 years, border, safe, small payoff, right? But when you have thousands of them all bundled together, suddenly the yield goes up, but the risk is still small because, well, the mortgages. Who the hell doesn't pay their mortgage?
What exactly is the credit rating on this bond?
This bond, gentlemen, is AAA rated.
This is exactly what the Michigan State Pension Fund has been looking for. I'll buy 20 million. Oh, come on. 25.
The money came raining down.
This is the Federal Reserve.
No. So this is talking about mortgage-backed securities and what they are and how they started. And I'll explain what mortgage-backed securities are. So mortgages follow mortgage-backed securities and how they trade on Wall Street. So there's a reason why I was talking about treasuries. So treasuries are an investment grade bond, right? Obviously, it's AAA. It's the safest investment you can have. The US is not going to default on their debts. That's the idea, right? So mortgage bonds are considered AAA rated, like he was saying. And did you hear he's the Michigan State Pension Fund, right? So these pension plans, life insurance companies buy safe bonds. So the safer the investment, obviously you're going to get paid back, but the lower the return, right? So if I'm a mortgage bond holder, or I'm somebody that's selling mortgage bonds, and I go to you as an investor, and I say, hey, I'm going to offer you a rate of return for buying my mortgage bonds, okay? And I'm going to offer you the same rate of return that the US Treasury is offering on their bond. You're not going to buy my bond because I'm more risky, right? So I have to offer a greater rate of return in order for you to purchase my mortgage bond. And I'm going to explain why there's a spread and why treasuries and mortgage-backed securities tick very closely with each other, right? So mortgage-backed securities are AAA rated investment products. They're very, very safe because who's not going to pay their mortgage, right? So what a mortgage-backed security is, this tells you, it's an investment secured by a collection of mortgages. So in the beginning, you heard that guy say, hey, like one mortgage, there's one payoff. Well, if you're giving me $1 million, all right, like you're the investor for my mortgage, there's a lot of risk in that. If I don't pay you, you're going to have to foreclose on me, or we're going to miss the cash flows on that investment. Well, if you're buying all of our mortgages in this room right now and I don't pay you, you still have 10 other people that are going to pay you on their mortgage, right? So you have monies coming in. So a mortgage-backed security is an investment vehicle that lessens the risk. Your yield increases because you've pooled all these mortgages together, and it helps free up the monetary system. So it's a collection of mortgages and the share of the principal and interest payments made on that pool of loans. Another reason why mortgage-backed securities are different than treasuries, treasuries pay every 6 months. You get interest payments until maturity. With mortgages, you get a share of the principal and the interest payment that comes in that month. So every month you're receiving cash flows and you're receiving some of your principal back that you can then reinvest, right? And then when somebody pays the mortgage off, you get the full principal balance amount back. So most mortgage-backed securities are issued by Fannie Mae, Freddie Mac, and Ginnie Mae. Everybody familiar with Fannie, Freddie, and Ginnie? Right? So Julie did a class on Fannie Mae foreclosures, right? So when Wells Fargo or Quicken or True Blue Lending, when we issue a loan, that loan is packaged and sold to Fannie Mae and Freddie Mac. Okay, very simply. So we don't have an unlimited amount of money. Nobody does. And so we fund and originate loans and then sell them on the back end. Okay, so Fannie and Freddie purchase these. They're government sponsored entities. They are not part of the federal government. They're just sponsored by the federal government. And they buy the most loans on the secondary market. So Fannie and Freddie buy all these loans and then they package them together in mortgage-backed securities, and they sell the mortgage-backed securities on Wall Street to pension plans, life insurance companies, mom and pop investors, all that purchase MBS, mortgage-backed securities. The Federal Reserve purchased, this is the kicker, they purchased more than $2 trillion in mortgage-backed securities dating back to 2008. So you have an investor that's creating money out of thin air, that's buying bonds, that doesn't care about the rate of return, $2 trillion worth since 2008. So that distorted the mortgage market dating back that far, which is pretty wild. And then mortgage-backed security yields determine the mortgage rates today. So there's different coupons that we price off of. Right now, we're pricing off the 6% Fannie Mae coupon, and I'm going to show you what that looks like. So this is a 6% coupon. This is dating back to August of 2022. So do you guys recognize this? In my morning posts, I'll put this chart out there. So I'm going to explain what it means and how to read it, okay? So this is going all the way out to this week. So a couple of things to see. So if it's red, that's bad. Okay, very simple. If it's green, that's good. So in the mornings, if you see green, yay, mortgage rates are getting better. So look in the last week, this is dating back to Thursday. So Thursday, Friday, Monday, we had red shit happening. Not good to mortgage rates. So when people say that the reason why this is good for you is number one, you're going to know what's happening in the market. But when you get a client and says, hey, rates are coming down. I heard that rates came down this week. You could say, well, yeah, they did. Or you could say, no, they didn't come down. They actually went up. So red is not good for us. Green is. So this is a chart like any mortgage or stock chart that you're going to see. There's a resistance and a support. So the support is kind of where we're ticking on the better portion of that rate. On the bottom part of this chart, if it goes down, it means that rates are getting higher. If it's on the top, it means that there's resistance to rates getting better. So you could see it's been a tight band, and dating back to December, it's been kind of range bound, trading sideways, right? It hasn't broken out one way or another. It's kind of stuck where it's been. We had in here, this is where rates were like 7% that you can see dating back to late October, early November. Rates were in the 7% range, and then they improved a little bit, and then we've been trading sideways. The one thing that I think would be really good for you guys to know when you're looking at a chart like this, rates improve slowly and they get bad really, really fast. So this big green candle, that's an outlier. So you can see if you look back to, I don't know, December, we'll go back to December. It took rates about a month, 2 months to go all the way over to February to improve it all. You see, and it's hard for me because there's all these chords, but so check it out. So we're here December. So we got really better, and then rates got a little bit worse, and then a little bit better. So it took from December all the way until February for rates to improve. And then in 3 days, we lost what we gained over about a month.
Yeah.
You see that?
Is that historically the pattern?
Just
recently.
No, so historically the pattern is, and it's a great, the first company I ever worked for, the president explained it to me. He said, think of rates like you're holding a rubber band between your two fingers, and you pull down and you get a lot of resistance to rates coming down. But as soon as you let go, that mother shoots high. That's what happens with rates. There's a lot of resistance on the downside, but when they go up fast. Why is that? Because companies that are purchasing mortgage-backed securities are hedging against loss. So if I'm issuing you like originating a loan today and I'm going to sell it on the secondary market, if I give you a rate that's really good and rates like deteriorate and yields go higher, I can't sell that bond on the secondary market because I'm offering them below rate of return. And so they hedge against that loss by skyrocketing rates really quickly. So when you see them coming down, people are like, yeah, rates are doing great. And it's like, yeah, they are, and I'm going to wait 6 months to buy because rates are coming down. It's like, look, I mean, I see this all day, and of course I have a vested interest, and people think that you're trying to sell them something, but straight up, over 20 years, I can tell you, rates will go up faster than they're going to come down, unless like the Federal Reserve comes in and starts buying bonds. If the Federal Reserve comes in right now and starts buying mortgage-backed securities, we're going to go back to that yield that was in 2020 again, because they're buying them. So they're going to buy treasuries and mortgage-backed securities to help stabilize the economy. If that happens, then we're going to see rates really, really come down. But there's no indication that they're going to do that. What they're saying right now is, hey, inflation is running out of control, or we want to keep inflation under control. So if they're trying to keep inflation under the control, why are they going to flood the market with tens of millions of dollars per month purchasing treasuries and mortgage-backed securities? They probably won't. I could be totally wrong and off base, but if inflation continues to improve, then you're going to see bond yields come down like we've talked about in treasuries, right? That's going to happen because inflation's tamping down. And as a result, you'll see mortgage-backed securities, those yields will come down as well, right? It's actually yields going up and rates coming down, but you get what I'm saying. So this is a tick for tick on the 30-year mortgage bond and the 10-year treasury rate dating back to 1971. So you could see in 1982, for people who are on the Zoom, that rate was like 19%. Okay, and remember, if you remember, the 10-year treasury dating back at that time was like 12.5%, right? So it was high. And then you could see that it's ticked down. So the 10-year treasury and the mortgage bond go hand in hand with each other. So if you don't have my charts and you're out looking at my morning stuff, if you just look at 10-year treasuries and how they're trading, you'll be able to tell people what's happening to mortgage rates. I'm trying to let you in, Frank. It's letting you in and out.
Inflation controls rate or rates controls inflation?
Because of inflation, bond yields have to rise because of the purchasing power that's being lost due to inflation.
So if inflation went down?
If inflation decreases, then those bond yields will decrease. Rates are going to get better. Yep. So as inflation decreases, mortgage bonds will get better.
So let me ask you, so those people who buy in bonds, right, for 30 years,
Yes.
why they're so focused on the inflation, which is today, because the inflation was in 30 years, like it can eat up of their chunk of their money, like in a year.
Right. Right.
So why it's so, you know, like such a direct, fast correlation in between the daily or like weekly inflation?
They're looking at long-term trends. So the question was, why are like a 30-year treasury yield? Why are they concerned about inflation? So they're looking at long-term trends, right? So they're saying, hey, can I invest my money today in a 30-year bond, or can I go put it in something else? And what's that rate of return? I don't understand why companies and foreign nations would buy 30-year debt. I mean, that's a long outlook. What's that?
They get paid annually.
It's every 6 months. They get interest every 6 months, whatever the yield is. And then, no, it doesn't compound. And then they get the principal balance amount upon maturity. And a lot of the treasuries and mortgage-backed securities, they're bought and sold on the secondary market all the time. So as a bond goes through its maturity, the value of that bond decreases. And so you might want to offload that to somebody. And how that works, I mean, those are complicated financial things. I don't understand like the nuances on why people would buy a 30-year bond other than a 10-year treasury note, for instance. And there's some corporations that have sold like 100-year bonds, which is totally insane. And they're talking about doing a 100-year bond in the treasury, but I don't think that they're
Can
going
you
to
borrow
issue it.
against it?
Yeah, well, you sell it, but yeah, you can borrow against any asset, really. If you find somebody that's willing to lend you money against an asset, yeah, you can borrow against it. People borrow, I mean, that's like Bitcoin. People will put their Bitcoin out there and they borrow against it. Yeah, you can do all that with stocks. That's what shorting stocks is about. So the 30-year mortgage and 10-year treasury spread. So this is the spread between the 10-year treasury bond and mortgage bonds, right? So you could see it varies, but it kind of, there's like a band in here. It's like 1.5% to 3%. Really, it's kind of 1.5% to 2.5%. So again, if you don't have charts and you're just looking at 10-year treasury yields, you could say, hey, you know what? A mortgage bond is probably spread out maybe 3% from a treasury bond right now. And that's something that you can look at. So here's the charts that I send out every day. So I'm focused on the upper left-hand corner and the lower right-hand corner when I send my stuff out. So this upper right-hand corner, that's a 5.5% coupon. We aren't pricing mortgages off a 5.5% coupon. So that doesn't really, we're not interested in that. And then this is the Ginnie Mae coupon in the lower left-hand corner. Mortgages typically don't price off a Ginnie Mae because they aren't the largest purchaser on the secondary market. But we see what's happening with that Ginnie Mae coupon. So in the upper left, this is the Fannie Mae 6% coupon. So this is what everybody is pricing off. So again, 8 basis points, right? So that's not much. If it was 25 basis points, that would be 0.25%. So we don't typically see mortgage rates move unless that number is 15% or 15 basis points or more. Okay, so that 15 basis points is about 1/8 of a rate. When we get to 25 bips, that's 1/4. If this goes green by 25 basis points, this is the easy way to read this. That means that the rate that started out in the morning, you can get the same rate, but now it's going to be 0.25% less in cost for that rate. If it's red by 25 basis points, it means that that same rate that started in the morning, let's say it was 6%, is now going to cost you 0.25% in cost to get that rate. So that means that rates go up, right? Because people don't want to pay cost for the rate. So why do we have to do that? Well, we raise the rate to cover the cost. That's why investment properties are higher rates. right? You can get the same rate on a primary residence as you can with an investment property. It's just going to cost you a lot of money. So people don't want to pay 3 points in cost for an investment property loan. So they raise the rate and that eliminates the cost. This 10-year treasury note down here, if it's green, it's good for investors. If it's green, it's not good for us. Okay, that means that yields have had to have been increased, which means that this upper left-hand corner, this mortgage bond, those rates are going to get worse. Okay, so 10-year treasury notes, check that out in the morning. Check this out. When it's green, it means that it opened up better. And then now I'm sending beginning of the day and I'm sending you guys end of day so you can see where it ended. Because if I just send in the morning, that's just where it opened up from the last. So it opened at 102.08. So that's 2% premium going to the investor for a 6% interest rate. The last was 102.16, which is where you get that 0.8 basis points different. So the yield is increasing on this mortgage-backed security, which means that rates are getting less because it's a more attractive investment. And then it shows you what the high was and the low. So I just threw a lot of stuff at you on that page. Is there any, because I'm going to move on from this one, but I don't want to leave you in the dust. So any questions?
Is it always a coupon 6.0, or let's say, you know, like in 2021, it was a coupon 3.0?
Right. So the question is it always going to price off the 6% coupon, or are there other coupons that it's going to price off of? It will price off of other coupons. So the coupon, let's say rates get better, it'll price off the 4% coupon or the 3% or the 5.5% coupon.
How often the coupons are changing?
So they change based on the price. So as yields increase, the 10-year treasury goes higher, they're going to price different bonds.
So they can be every day, every month, whatever
It-
the change happens?
This changes daily.
But
So
the-
right now we're pricing off the 6% coupon because that's where the range is in mortgage rates. If we got really, really bad in rates, they would jump to the 6.5 and the 7% coupon, and it would stay there. If rates were running out of control, it would go 6.5, 7, 7.5, 8, 8.5% coupon, and it could happen in the period of a week. But that's like catastrophic rate increases.
And then those coupons, like everyone trading based on that coupon
Yes.
specific time.
Yes.
So if I'm sitting here, if I'm sitting in California, I'm sitting in Utah, whatever, everyone's gonna be talking about the same coupon.
Right. Every single person is pricing off the same coupon right now. Why is that? Because Wells Fargo, True Blue Lending, Chase, Quicken, we originate loans, we sell them on the secondary market. Who purchases them? Fannie Mae. This is the Fannie Mae 6% coupon. So they are setting the price on these mortgage bonds on the secondary market. And so all of us are pricing off this coupon. Now, we don't all get our money from the same place, which is why some lenders have higher rates. We all have different margins, which means I have to make more on your loan and I'm going to give you a higher interest rate so I can make more on your loan. That determines individual specific interest rates with investors. And I'm going to show you my pricing engine at the end of this, and it'll make sense. You're going to see all the lenders and where they price, and you'll see, like, that's why we like being a broker, is because we have 18 lenders that we can choose from. So we're not just stuck with one place of money, right?
So Fannie Mae can pretty much tomorrow say, hey, you know what, if it goes up, like, we right now selling the coupons of 7 or 6
Right.
or whatever it is. So you don't know when you wake up if it's gonna be same coupon or not, it's just based on Fannie and Freddie.
Yeah, so yeah,
Like there's no like a quarterly or monthly change.
no, so there's no like, hey, this quarter we're gonna only trade the 6% coupon. Next quarter we're gonna trade the 5.5% coupon. So the coupon will change based on what treasury yields are doing and what investors have to offer, or what bond sellers have to offer investors yields to purchase their mortgage bonds. So it's all tied to that 10-year treasury
Because
note.
for example, if I'm reading, let's say like 2 articles, one from 2019, and I'm doing the comparison of
Right.
a specific market, right?
Right.
And like specific investment, and then I see like, you know, like that's some, like that statistic for the coupon, but it's gonna be like 5.0, let's say. And today you given me a statistic of the coupon 6.0.
Right.
So that's, you know, that's where I'm coming from, like, for me to analyze those two.
Right. So a rule. So if you don't have this chart showing you that, like, let's say what you're saying, hey, I was looking at 1981, where treasury yields were back then. How do I know where mortgage rates were? Well, the spread between the T-bond and mortgages was about 4.5%. So if the T-bond was trading at 12.5, your rate in 1981 is probably going to be 16, 17%, right? So on average, if you look here, not average, but it trades in a range of like 1.5% to 2.5%, generally speaking. And this is dating back to say 1990 all the way through 2021. 2021, it's a 3% spread right now.
What would be the events which would make the spread be like 4.5 or 5? Like what happened in 1980 that the spread was so
Well,
big?
inflation was crazy in the late 70s, early 80s.
So
So
they were kind of playing safe, was the spread, was that delta?
yeah, so my assumption on why the spread was so great is maybe mortgages weren't a super safe investment at that time. And so in order for me to make a mortgage attractive to you as an investor, I've got to offer you a high yield. So like everybody's heard greater risk, greater reward, right? Lower risk, lower reward. It's the same thing with bonds. So the higher the risk, I've got to offer you a lot. So I'm a high risk, right? So in order for you to lend me money, I've got to offer you a ton of money in a rate of return, right? So I don't know. I haven't researched why the spreads were so high. I'm just knowing the markets. I'm going to say it's because mortgages weren't a super safe investment at that point in time.
When did they start on doing the mortgage-backed securities like we were talking in this video? Wasn't this 80s?
Yeah. So, I mean, this chart goes back into the 70s.
But so that's when, like from the movie, that little scene when they started trading it.
Right.
That was 70s.
Yep. Pretty crazy, huh? Wall Street, they're always trying to make money and come up with all sorts of crazy investment vehicles. So 48-hour chart, this is one that I send out to you. I don't send the daily chart in this format because we don't care. I tell you at the end of the day where it was, but you could see, I mean, if you look at the daily chart, the support was, we were down as low as 102, and then we were as high as 102.4. Okay, that's like a 0.5% spread throughout the day. So when people say, hey, rates, when do they move? They move all day, every day, except on weekends.
Do you have the ability to lock it in at a certain time of the day?
Yeah, I can lock a rate right now. I could lock a rate 5 minutes from now. I can forward lock a to be determined purchase. It's a 60-day lock. So even if you don't have a property in contract, we can still lock an interest rate. The longer I lock a rate, the worse the pricing is for our client. So we typically lock rates on 22-day locks here because we can close in 10 to 14 days, depending on the client. So this 48-hour chart, so you want to look. So red's the prior day, blue is today. And this will show you how it differed from the previous day. And again, if we're at the bottom here, that doesn't mean that rates are lower. It means that rates got worse. Why? Because that yield decreased. Okay, so this is yields, not rates. So the higher the yield, the better the rate.
Inverse.
Right, it's inverse. Green is good, red is bad. Questions? Anybody?
Thanks for your choice.
Yeah, I love that. Anybody have any questions on the Zoom? No? Okay, I'm going to show everybody what I use to price mortgages. I think you guys will find this interesting. All right, so this is our chart. This is what I look at all day, every day. I don't know, everybody on the Zoom, can you see it? So this is telling me all day. I have this up on my screen. So we're 22 basis points worse in yield now than we started yesterday. So I want you to look at something that's pretty crazy. So this is where we're at with rates right now. So this is Friday, Monday, Tuesday. Actually, let's see. So Friday, Thursday, Wednesday, Tuesday, Monday, Friday, Thursday. So look, just dating back 1 week, how much we lost in interest rates. This goes back to January. So in a week period, we lost over a month of gains. Look, rates were getting better. Shit the bed. Big time. They gordied it.
I think it's gonna hit that support right there.
But that's
No, see, that's the thing. Right now, the 10-year treasury has banged through its support level. Now, it could come back. It could. I mean, this stuff is like super, super fresh right now.
So what happened with this week that would trigger that?
Yeah, so what happened this week is that the 30-year treasury auction that happened yesterday had a shitty bid to cover. Nobody wanted the 30-year paper. So the treasury had to offer really high yields to get investors to buy it because there weren't. What?
How manipulated is this auction? Like,
How many what?
how manipulated it is? Because like, it feels like it's very.
How manipulated?
Yes.
It's an auction.
You have big players.
It can be, yeah. I mean, it's an auction. So we all get together and say, hey, I'm gonna give you, I want 10 million. Yeah, you got 50 mil.
So what?
So look, here's our support level.
What made the
white
auction
ones.
yesterday, like what made the bonds so?
So this is what is crazy about the market, okay? Earlier in the week, Wednesday, there was a 10-year treasury auction that was, or it was Tuesday, that was spectacular. Bid to cover, out of control. A bunch of people wanted 10-year paper from the treasury. Rates had a little bit of an improvement. It was good. 2 days later, the 30-year hits, nobody wants it, and the market dumps. Like, why? Who the hell knows, dude? You know what I'm saying? Like, this stuff is, that's why when people say, I know a market crash is coming, I know rates are going to improve. It's like, you do? You knew that the 30-year bond auction was going to go bad on Thursday and it was going to tank treasuries. How did you know that? I'm curious to find out. So what I say is, look, like, don't time the market. You'll never time the market. But if you can afford it right now, what are you waiting for? There's many benefits to home ownership. Can rates get better? They can. And you can refinance. You can. If they don't, you're locking in a rate today that's fixed for 30 years that you can afford. What's the problem? I don't understand why people want to wait. It's insane to me.
But that's why the CPI came down, that's why maybe the prices went down.
No, so the bond, this auction that happened yesterday had nothing to do with CPI.
Where do you see options? Like, what answers do you have for?
Yeah, so we watch it in the morning. You can Google bond auctions and see what the bid to cover was and what the action is. You could see it. It'll tell you what the stop through. So here, let me see if I can find. Let's see. I mean, crude oil prices, this goes into all sorts of stuff. And this is what I read all, I mean, I love this stuff. So here's a piece of news. So Barclays, they think the Fed is going to continue with 25 basis point rate hikes through June, followed by a pause through December. Earlier this week, people were saying that they were going to stop after the March meeting. So this changes like every single day. The market, the way that the market sees this stuff flips around. And I think they pushed it off, but that's too bad. So here, I'm going to show you guys like if we were going to search for a rate for a client. So this is a system that we pay for. All the lenders throw their rates into this system and we can tell where the rates are pricing out. So let's see, let me go to. So when somebody comes to me and says, hey, I want to get a mortgage, and we get their FICO, we throw all of their information into this system. So this says, like, let me look at conventional because it's going to be more on what we're looking for. So I want a conventional loan. I want a 30-year term, fixed rate. It's a purchase. I'm buying for $400. I'm going to put 20% down. I'm not self-employed. I'm not a first-time home buyer. I've got a 760 FICO, my DTI. These are all things that go into pricing an individual person's loan. Okay, so we looked at bonds and how that changes prices in general. And then we get down to the individual level, right? How long we're going to lock the rate, whether or not we're getting paid from the borrower or the lender. All these things are different, where it's located, if it's a single family, condo, PUD, 2-unit, etc. So this is a single family, 760 FICO, 20% down payment, purchase money loan. This is where rates are. So look, this isn't just one company. This is everybody. There's our friends at Homebridge, our really good friends. They're 5.625, It's going to cost your client a 0.5 point in cost if they go to Homebridge today for a 5.625 rate. But if they come to True Blue, since we're a broker, we're going to give them 5.625, getting a quarter back in rebate. That's 0.75% in cost better by coming here because we're a broker shop. We don't want to go to a different lender that's not pricing out good, right? So here's where if the client wants to buy the rate down, they can. So remember, green is good, red is bad, right? So this client, yes, I'll show it to you in a sec. I'll go back. So 5.625, the client isn't paying any points for that rate today, okay? It's $928 back to the client with this loan amount. If they want a 4.625% rate, it's available. But remember, if I'm a lender, why am I going to give you a 4% interest rate when I can give Julie a 5.625% interest rate and make more money? I'm not going to give you that lower rate. But if you pay me money, so you're basically prepaying interest up front, I'll give you this rate. Because now my yield on that money is the same as an investor because you just paid me 12 grand in fee. Right? So you can get a 4.625 rate, but it's going to cost you 4 points to buy that rate down, which is 12.5 grand.
You're basically paying for it anyway, right?
Right. Yeah. Because I'm going to give you money and I'm not going to get a 4.5% rate of return when I can lend somebody else and make 5.625.
It compounds, so they're actually saving money over the term of the loan.
Yeah, of course. Yeah. If you buy down to 4.625, you're going to save more than that over the term of the loan.
Wants to get this 12,000 back.
Right. And it's actually, and I mean, I'm not going to get too crazy, but like there's laws against how much money I can charge. I literally can't charge you that much. The most I can charge in a transaction in the origination section is 3 points. So the lowest that this client could buy the rate down would be to 4.875 because it's 2.771 in fee.
Why the others weren't even available over there?
What's that?
If you cannot charge 12.5, why it's even on the?
It just shows you.
You could do 2 mortgages, right? And 2 points on each.
Yeah, you can, but yeah, you're not going to do that. So what I was saying, Mohammed, is like these are all the lenders, right? So if you look at the best priced lender today, and so we're signed up with these companies. I wouldn't use InterFirst. They're not a good company to work with. They're a pain in the ass. They aren't going to close your loan in 17 days. They're going to close it in 60 days. We don't want that. So we would go to somebody like PennyMac, who we've done a lot of business with. They're a really large lender. They're very good. But you can see that the price is a little bit worse. So 5.625 with PennyMac, you're not going to get all that rebate, right? It's a little bit worse. It's a 0.25%. So PennyMac, we'll just use them so you can understand. PennyMac today, 99.908, that's basically par. So that means that you can get a 5.625% rate with PennyMac under these circumstances and not pay any points, okay? So you're not paying money to get that rate. But if you went to a company like, oh, I don't know, Homebridge.
Pay the interest before the loan, so is it better to pay like a bigger down payment or
Yes.
to buy
It is.
points?
It's both. So if you went to this company, that same 5.625 rate is going to cost you $1,600 in fee to get. So we wouldn't send it to them, or we wouldn't send it to UWM or A&D. So we're signed up with all these. We're signed up with Homebridge too, and Michigan Mutual, and PRMG, and Kind, and Rocket, and Flagstar. We're signed up with all these companies. I don't know who HTEM is. They must be new. I've never heard of them before. EPMG, we're signed up with them. PennyMac signed up with them. So we're signed up with all the wholesale lenders, the very best wholesale lenders. So that's how rates vary individually. So now I gave you kind of global and I gave you down macro stuff.
Those little fees, like 1,600 or so and all that, are those paid up front before closing or when you consume the loan?
At closing.
Okay.
Right.
And then, like, for example, you saying that, like, the first one, you know, you spoke shit about this company and you said we will not give them business because they.
InterFirst, yeah, they suck.
So let's.
It's going to
say-
affect our reputation.
Let's say we're talking about, you know, like different lenders, right? Like different mortgage brokers.
Yes.
So is it a factor that some of them are too slow because they just chose that wholesale and they gave them trouble, that's why we couldn't close? like on the back end.
Right, right.
Is that one of those which will dictate a good lender or bad lender, kind of like knowing the reputation was a wholesale in order to bring the loan to the closing?
Right. Yeah, that actually is a really good question.
So
So
is this where underwriter comes in, or like?
yeah, I know what you're asking. So the question is, who is to blame when a loan takes forever and when underwriting goes bad? Who's to blame? Is it the lender or is it the broker or is it the direct lender?
Mhm.
Who's to blame? So the answer is all of the above. So if I'm brand new in the industry, so like for instance, we were talking earlier about an FHA purchase on a 3-unit property. If I'm new or if I've never done a loan before, or maybe I've never done that type of a loan, I'm not going to know that that property needs to be self-sufficient. So I'm going to look at your debt to income and I'm going to say, hey, you qualify for this purchase. Awesome. Let's do it. Yeah, cool. We're in contract. Killer. We're going to close. Oh, fuck. This thing isn't self-sufficient. You know what? I'm sorry. You can't do the loan. Is that the lender's fault or the person, the originator's fault? That's the originator's fault because I didn't prep you, right? Hey, you know what? This condo has no reserves. They don't fund anything. There's deferred maintenance. They're doing work on a 50-year. Yeah, hey, let's do a 3% down payment on that condo. Does that sound good? Yeah, that sounds great. Awesome. You're never going to close that loan. So that's the originator is messing up. So like if you work with somebody like me or our friends at Homebridge, they have a lot of experience, right? So I have 20 years in the business and so do they. So there's a lot of very seasoned loan originators that have a lot of experience that can keep you from getting into trouble. Some lenders are not good lenders. So even if I front run everything and I know it's all good, I'm not going to send my loan to the very best priced lender unless it's a company like PennyMac, HomePoint, Quicken, UWM. These companies have systems in place that make the loan go really, really fast. And another thing is that we underwrite to Fannie Mae and Freddie Mac guidelines. So there are some lenders that have investor-specific overlays that are more stringent than Fannie Mae requirements. Every loan that we get in, if there's a little bit like a quirk to the loan where we know, hey, there might be an issue here, we check. So we're working with a client right now who has been out of work for 2 years, hasn't filed tax returns. They're back into the workforce as of 6 months ago. And that is not a problem for Fannie Mae and Freddie Mac. That's called a gap in employment. So I know for sure that Fannie and Freddie don't have gap in employment guidelines. FHA does, VA does. Like I couldn't do that loan VA because he's not back to work for a year, right? So I know that because I've been doing a shitload of loans. I know what's up. But I still check with the lender and say, hey, so I've got a guy who's just back to work after being off for 2 years. Do you have any gap in employment overlays? And they say, no, I don't. I underwrite to Fannie and Freddie. We're sending the loan to you. So we front run that stuff up front. So most of it is where you run into problems is the loan originator that you're working with. That's the main issue because they don't know what they're dealing with. They don't know the problems that they need to look out for. That's why we close loans in 14 days.
Let me ask you, so, if I'm representing the buyer who decided to pick their own lender, just because we know how it is, right?
Right.
And to pick one of those, like the first ones, how can I predict that we might be in a shithole if, like, during the process before we got there? Like, how can I get to the back end who you guys gonna sell it to?
Right.
Information in order for me to understand, do I need Jesse to be on a standby a week before closing just in case? I like to prevent things, right?
Yeah,
Like,
no,
that's
of
why I
course.
Tables because, you know, if I see that we have a fucking broken
Right.
mortgage, well, I always have somebody on standby, willing to go like any second. You know,
Right.
if I have the buyer who's like, no, that's who I wanna use.
Right.
So how can I understand if I'm working first time with a person unknown out of the blue?
You won't know.
So that is information which is not available for me. That's just only in between you and.
So Fannie Mae guidelines are 1,400 pages long.
Holy shit.
So you as a realtor are an expert in buying, selling, leasing homes. You are an expert. So if I came to you and asked you, hey, if I get into contract, how many days am I going to have to do my inspections? You can answer that question off the top. I don't know that that's even a question. So there's things that a lot of people in my industry, they don't know. They're like brand new. They come in, they're chop shop. They worked flipping burgers a week ago. Now they're doing loans and, you know, oh, cool. I recognize the company name. That's why you want to work with somebody that you know and trust and who's been in the business a minute.
But I'm thinking about the wholesales because
Right.
Because is there like a Yelp for the wholesales company?
For the lenders? Yeah, I mean, people, people,
Not for the front, you know, like not from the.
right. So I've done loans with Home Point and send disclosures out for Home Point. And I've had clients say, hey, I looked at Home Point's reviews online. They suck. And I'm like, really? Well, what does that mean? Why does Home Point suck? Because somebody reviewed them and said they suck? Who was the loan officer? Did you have bad credit? Did you have something? Did you buy a car a week before closing and it fell through and now you're giving bad reviews for the lender? You can't tell because you don't, I can't tell like if there's a bad review. I don't know what the specifics were on that. So there's nothing that you can do. You just like, we've done loans with so many of these lenders so many times. I mean, it's insane. So we know who we can trust. I'll tell you that there are a few that you're going to work with regularly. So PennyMac, huge wholesale lender, and they have a retail channel. EPMG, I've done a loan with them once. I had to do it because they were the only company that could do the loan with this client's score. It was a VA loan. I'll never use them again. So like, I don't use companies I've not worked with unless they're the only option. And I prep the client and say, hey, look, like we're working with a company. We don't have a good history with them. So you might need a little bit more extra time on the contract. I've worked with them. Flagstar, they're a huge bank. So Rocket, they're killer. Rocket's fantastic.
What's the problem? Was there a review?
You're working with somebody who was flipping burgers a week ago.
Because they're
right.
painful things I haven't.
Right. So Rocket, I've submitted pre-approvals to realtors and I call every realtor and say, hey, I'm just introducing myself. You know, we've got all this stuff. Some realtors will say stuff like, who are you sending the loan to? Yeah, I'm sending it to Rocket. They're the best priced. I'll never work with Rocket. Why is that? Well, because we had a nightmare situation. Okay, was it Rocket or was it the loan originator that you worked with or was it your client? Well, I don't know. Okay, then why are you not going to work with Rocket? I could tell you I've got a lot of experience. I'm not going to put you through a nightmare situation. So you don't know who you're working with. And that is really kind of the bummer in the business is if a client comes to you and they've got their own lender, I mean, what are you going to not take the deal? Of course, you're going to take the deal.
Right now, I really, you know, I put all the effort not to work with Rocket because I went through seven front faces for one client.
Right.
So for me, it was not about the person, it was about the systems behind.
Right.
And it was about accountability behind as a company.
Right.
Which failed.
Right. Well, I mean, listen, yeah, I get you. I understand. And I see why you wouldn't want to work with them.
But wholesale and retail is different.
They can be, yeah. And so some people say, hey, you're a broker, you don't have control over the process. You don't have control over the underwriters. Well, of course I do. I know what the underwriting criteria is at this company. I know that they underwrite to Fannie Mae guidelines. So it's Fannie Mae that we're working with, not with Rocket or not with United Wholesale Mortgage. Like I know that they underwrite to Fannie. Your client meets Fannie Mae guidelines. What's the problem? And it's really about like how much you get up front, right? Like if you're self-employed, I know I need 1040s. I need your business tax returns if you have them. I need the K1s. I need the W2s if they show on the tax returns. I need your pay stubs. I need your insurance. I need your HOA. I need all this stuff. We get it up front. And then that way, when we get in contract, we submit it and it goes through underwriting clean. We're underwritten in a day with a clean approval. We go to the client. There's no surprises. Very rarely is there a surprise that pops up. If you do your due diligence up front, you're going to have a relatively or very smooth transaction. But there really is no way that you know who you're working with unless you have a track record or you know their experience level. And it's tough. It's very difficult. So yeah, that's that. Does that answer your question? Sweet. All right, cool. Well, I'm going to let everybody go. I appreciate everybody jumping on. It's been about an hour. Text or email me if you guys have any questions that were on the Zoom. Here for you guys. Now, hopefully you'll understand our morning updates and yeah, let's get out there and get her done. Thanks, everybody.
Thanks,
Thanks, Jesse.
Thank you.